More Money Than God, Hedge Funds and the Making of a New Elite by Sebastian Mallaby. Picture this, a man who spent his youth working on a tramp steamer, studying at a Marxist school in Berlin, and running secret missions for an anti-Nazi resistance group. He honeymooned on the front lines of the Spanish Civil War, drinking with Ernest Hemingway and Dorothy Parker. Now, fast forward to this same man at age 48, creating a financial vehicle so powerful and revolutionary that it would forge a new global elite, challenge governments, and generate fortunes that would make the Rockefellers and Carnegies look like they were running a lemonade stand. Sounds like something out of a spy thriller, right? But this man was real. His name was Alfred Winslow Jones, and he accidentally invented the world's first hedge fund. Today we're diving into Sebastian Mallaby's masterpiece, More Money Than God. This isn't just another finance book. It's about rebels, outcasts, and geniuses operating on the frontiers of the global economy. It's the story of how a small group of contrarian thinkers built an industry managing trillions of dollars, completely rewriting the rules of money and power. This book has sold hundreds of thousands of copies and stands as the definitive history of the hedge fund world. Sebastian Mallaby, a brilliant writer and fellow at the Council on Foreign Relations, spent years gaining unprecedented access to this secretive world, interviewing titans who rarely speak publicly. He didn't just report on them, he got inside their minds. By the end of our journey today, you'll understand the secret alpha game these legends play. You'll see how they spot opportunities everyone else misses, how they manage unimaginable risk, and how they built empires by betting against the consensus. This is more than a summary. It's an invitation into the minds of people who truly have made more money than God. Let's begin. Our story doesn't start on Wall Street, but in the chaotic ideological battlegrounds of 1930s Europe. Alfred Winslow Jones was the most unlikely financial pioneer you could imagine. He was a sociologist, a journalist, a former diplomat, and for a time, deeply sympathetic to Marxist ideas. He wasn't interested in getting rich. He was interested in understanding the world, its politics, its conflicts, its human psychology. But in 1949, at 48, with a family to support, he decided he needed to make some money. So he scraped together $100,000, some his own, some from friends, and set out to try his hand at investing. But Jones wasn't going to play by the old rules. The money managers of his day were called trustees. Their job was to be conservative, to preserve wealth, not necessarily to grow it. They bought stocks when they thought the market would rise, and held cash when they thought it would fall. Jones saw a third way. He developed a structure he called a hedged fund. The idea was revolutionary in its simplicity. Instead of just buying stocks he thought would go up, what we call going long, he would simultaneously sell stocks he thought would go down. This second part is called short selling. He would borrow shares of a company he believed was overvalued, sell them, and then buy them back later at a lower price, pocketing the difference. By being long on promising companies and short on unpromising ones, Jones created a portfolio partially insulated from overall market swings. If the whole market crashed, his short positions would make money, cushioning losses from his long positions. He had created a hedge. And because he was hedged, he felt safe doing something else considered radical at the time, using leverage. He borrowed money to make his bets bigger. He was using, as he put it, speculative means for conservative ends. Let's make this simple. Imagine two investors, both with $100,000. The traditional investor might put $80,000 into stocks and keep $20,000 in safe bonds. But the hedged investor, following Jones's model, might borrow another $100,000. With that $200,000 war chest, he could buy $130,000 worth of his favorite stocks and short sell $70,000 worth of stocks he disliked. Notice two things here. First, his exposure to the market is actually less than the traditional investor. His net exposure is only $60,000, $130,000 long minus $70,000 short, while the traditional investor is exposed by $80,000. Second, if the market goes up, his gains are magnified by leverage. If the market goes down, his shorts protect him. He had found a way to pursue higher returns with lower market risk. It was financial alchemy. And to top it off, Jones created an incentive structure that would define the industry for the next century. He didn't charge a flat management fee. Instead, he took 20% of the profits. He said he was inspired by ancient Phoenician sea merchants who kept a fifth of the profits from successful voyages. This performance fee aligned his interests perfectly with his investors and created a powerful drive to win. The results were staggering. Over the next 2 decades, Jones's fund delivered a cumulative return of nearly 5,000%. He crushed every competitor. But he did it quietly. He never advertised, never registered with regulators, and kept his circle of investors small and private. He was the ghost in the machine, the big daddy of a secret new industry. Jones had created the perfect vehicle, but he wasn't a master stock picker himself. His real genius was creating a system to get the best out of others. He set up a Darwinian culture where individual analysts were given capital to manage and rewarded based on their performance. It was a radical departure from the committee-driven decisions of traditional banks. It was pure, adrenaline-fueled individualism. But every great edge is eventually discovered. In the go-go market of the 1960s, dozens of imitators sprang up, many run by people who had once worked for Jones. They called themselves hedge funds, and they became the hot new thing on Wall Street. But most of them missed the point of Jones's innovation. They forgot the hedged part and focused only on the leverage, using borrowed money to ride the bull market. When the market crashed between 1969 and 1974, most of these gunslingers were wiped out. The first hedge fund era came to a screeching halt. The industry nearly died before it had truly begun. But in the ashes of that crash, a new kind of trader emerged, one who thrived on chaos. His name was Michael Steinhardt. Steinhardt was the opposite of the genteel Alfred Jones. He was a short, barrel-chested man from Brooklyn, raised by a gambling-addicted father, and he brought that same confrontational, high-stakes energy to the trading floor. He was known for terrifying outbursts of temper that could leave colleagues shaking. He launched his fund, Steinhardt, Fine, Berkowitz and Company, in 1967, during the height of the bull market. At first, they played the go-go game like everyone else. But as the 1960s came to a close, Steinhardt and his partners sensed that the party was over. Unlike most of their peers, they actually hedged. When the market collapsed, they didn't just survive, they made money. Steinhardt became the ultimate contrarian. He loved defending the consensus. When everyone was bullish, he was bearish. He bankrolled centrist Democrats in the 90s, then turned against them as soon as Bill Clinton entered the White House. He had no faith in God, but gave millions to Jewish causes. His entire philosophy was to bet against the crowd, and to bet big. An analyst once came to him, convinced that IBM stock was about to go up. He nervously suggested buying 10,000 shares. Steinhardt's gut told him the stock was a pig, but he saw the conviction in the young man's eyes. "How much you want to buy then?" he barked. "How about 10,000? The analyst ventured. Steinhardt hit a button and ordered his trader to buy 25,000 shares immediately. Then he bought another 25,000. He had just put a quarter of his fund's capital into a single stock, 5 times what his own analyst had recommended. It was an absolutely terrifying concentration of risk. But by the end of the week, the stock had shot up 20 points, yielding an instant profit of $1 million. Steinhardt's genius wasn't just in being a contrarian. It was in knowing when to trust the contrarian conviction of others, and then amplifying it with breathtaking scale. But where did this edge truly come from? It wasn't just guts. Steinhardt had stumbled upon a flaw in the seemingly perfect logic of the market. In the 1970s, investing was becoming professionalized. Giant pension funds and mutual funds were starting to trade huge blocks of stock, 100,000 shares at a time. The old specialists on the floor of the New York Stock Exchange couldn't handle that kind of volume. So a new game emerged: block trading. A pension fund needing to sell a massive position quickly couldn't just dump it on the open market without crashing the price. Instead, they would sell the entire block to a broker like Goldman Sachs at a discount. This is where Steinhardt came in. He made himself the go-to buyer for these discounted blocks. He had the guts, the capital, and the authority to make multi-million-dollar decisions in a heartbeat. While other firms had junior clerks on their trading desks, Steinhardt himself manned the phone. It was, as he loved to say, like taking candy from a baby. He was exploiting something the academic theories missed: liquidity. The theories assumed you could always buy or sell a stock at its efficient price. But in the real world, someone needing to sell a huge amount in a hurry creates a temporary price distortion. Steinhardt lived in that distortion. He was a provider of liquidity, and he charged a handsome fee for it. He had found his edge, his alpha. While Steinhardt was mastering the art of the trade, a different kind of revolution was brewing in a quiet farmhouse in Princeton, New Jersey. This was the birth of the quants, the quantitative analysts, the rocket scientists who would try to replace human intuition with computer models. In 1970, a brilliant but tormented PhD named Helmut Weimar started a firm called Commodities Corporation. His backers included the great economist Paul Samuelson, one of the fathers of the theory that markets are efficient and impossible to beat. But Weimar thought that was nonsense. He believed he could build mathematical models to predict the prices of commodities like cocoa and orange juice. His office was a world away from Wall Street's chaos. It was an intellectual sanctuary where PhDs filled blackboards with formulas and debated trading theories. Their goal was to beat the market with math and superior information. But the market had a brutal lesson for them. Early on, the team became convinced that a scare about corn blight was overblown. They believed corn prices would soon fall. So they built a massive short position, betting their entire firm on the advice of a plant pathologist. Then, one Friday night, CBS News ran a special report. An expert from Illinois, a state with a lot more corn than New Jersey, predicted a catastrophic harvest. When the markets opened on Monday, corn futures shot up so fast that trading was suspended. Weimar and his team were trapped. They couldn't get out of their positions. By the time they finally did, they had lost nearly 2/3 of their capital. The firm was on the brink of collapse. It was a near-death experience, and it forced Weimar to rethink everything. He had started with pure faith in fundamental analysis, in building models to predict where prices ought to be. But the corn debacle taught him a lesson in humility. He realized the market wasn't just about supply and demand. It was about psychology, momentum, and trends. His partner, Frank Vannerson, had been quietly working on a computer program that did just that. It didn't care about rainfall in West Africa or chocolate consumption in Europe. It just looked for trends in price data. It would buy things that were going up and sell things that were going down. Weimar was initially skeptical. It seemed too simple, almost trivial. But Vannerson's system had been making money consistently, even while Weimar's fundamental models were failing. After the corn disaster, Weimar embraced the new approach. Commodities Corporation pivoted from being a firm of fundamental analysts to a firm of trend followers. They became financial surfers, looking for waves in the market and riding them. And this led them to their greatest discovery, Michael Marcus. Marcus was not a PhD. He had no use for complex models. He was an intuitive trader, a student of charts, a believer in the psychology of the crowd. He would arrive at the office with a briefcase stuffed full of market reports, looking for the interaction between fundamentals and charts. If the news was bad but the price kept trending up, he knew investor psychology was so strong that nothing could stop the momentum. Over a 10-year period, Marcus increased his trading account by 2,500%. There were years when his profits were greater than all the other traders combined. Marcus's success transformed the firm. He preached the gospel of generalization. He didn't want to be a specialist in just cotton or soybeans. He wanted to trade everything, including a brand new market that was just emerging, Currencies. In 1971, President Nixon had abandoned the gold standard, and currencies began to float freely against each other. Marcus saw an opportunity to apply his surfing skills to a new beach. He, along with his protege Bruce Kovner and other young traders like Paul Tudor Jones and Louis Bacon, who were seeded by Commodities Corporation, became the pioneers of a new style of investing, macro trading. They weren't just betting on companies, they were betting on entire countries, on the grand movements of interest rates, inflation, and currencies. A new kind of hedge fund player was born, one that would soon grow powerful enough to challenge central banks. And no one embodied this new power more than the most famous hedge fund manager of all, George Soros. Soros was not like the other titans. He was a philosopher first, an investor second. A Hungarian Jew who had survived the Nazi occupation of Budapest, he arrived in London as a penniless student and fell under the spell of the philosopher Karl Popper. Popper argued that human beings can never know absolute truth. We can only grope toward it through trial and error. This idea resonated deeply with Soros, who had seen the false certainties of both Nazism and communism ravage his homeland. Soros developed his own philosophical theory, which he called reflexivity. The idea is profound but can be understood simply. Academic finance assumes that investors are rational observers of an objective reality. They analyze a company and determine its value. But Soros realized this was wrong. Investors aren't just observers. They are participants. Their perceptions don't just reflect reality. They shape it. Think of it this way. If investors believe a company is going to succeed, they'll buy its stock. The rising stock price makes it easier for the company to raise capital, attract talent, and make acquisitions. The company's success then reinforces the initial bullish perception, creating a feedback loop. This reflexive loop can drive prices far away from any fundamental value, creating booms and busts. Soros didn't see markets as tending toward a stable equilibrium. He saw them as being in a perpetual state of dynamic disequilibrium, always swinging between greed and fear. His goal wasn't to find the correct price of an asset. It was to identify the prevailing bias of the market, ride the reflexive feedback loop for as long as possible, and get out before it inevitably reversed. He launched his own fund in 1969, and his results were legendary. But his greatest trade, the one that cemented his status as a financial icon, came in 1985. At the time, the U.S. dollar was incredibly strong. It was hurting American exports and creating a massive trade deficit. Most economists believed the market would eventually self-correct. But Soros saw a reflexive process at play. Speculators were buying the dollar simply because it was going up, pushing it ever further from equilibrium. He knew this couldn't last forever. He sensed a reversal was coming. So he started keeping a diary, a real-time experiment, to sharpen his thinking. It reveals the mind of a master speculator at work, wrestling with doubts and complex scenarios. He agonized over the timing. Was the turn imminent? He decided to take a huge bet against the dollar, an exposure that exceeded the entire equity of his fund. For 3 weeks, the trade went against him. He lost $20 million. He was on a knife's edge. But he held on. Then, on September 22, 1985, the finance ministers of the 5 largest economies met at the Plaza Hotel in New York. They announced a coordinated plan to push the dollar down. The news delivered Soros an overnight profit of $30 million. But this is where the genius of Soros truly shines. Most traders would have cashed in their winnings and celebrated. Soros did the opposite. He piled on harder. The Plaza Accord was the trigger he had been waiting for. It had broken the market's bias. Now, a new reflexive feedback loop would take hold, this time driving the dollar down. He charged out of his office, yelling at his traders to stop taking profits. He took over their positions and bought more and more and more. Go for the jugular, he would later tell his protege. In the 4 months following the Plaza Accord, Soros's fund jumped by 35%, yielding a profit of $230 million. He had made what he called the killing of a lifetime. Soros's success, and his book The Alchemy of Finance, inspired a new generation of macro traders, including a young, flamboyant cowboy named Paul Tudor Jones. Jones was a prodigy who saw markets as a high-speed game of poker. It wasn't about economic data. It was about getting inside the heads of other traders, sensing their fear and greed, and bluffing them into a panic. In the run-up to the stock market crash of 1987, Jones became convinced a collapse was coming. He had his young economist, Peter Borish, map the 1980s market against the charts leading up to 1929. The lines looked eerily similar. Jones predicted total rock and roll. When the market began to fall on Friday, October 16th, he didn't hesitate. He sold massive amounts of S&P 500 futures. On Black Monday, as the Dow lost nearly 23% of its value in a single day, and panic paralyzed Wall Street, Jones rode the cascade all the way down. But he didn't stop there. He reasoned that the Federal Reserve would have to slash interest rates to calm the panic. So, in the midst of the equity crash, he bought the largest position in government bonds he had ever owned. He made a fortune on the way down, and another fortune on the way back up. His fund returned 200% that year. The success of Soros and Jones set the stage for the ultimate macro trade, the one that would prove hedge funds could be more powerful than sovereign nations. This was the battle for the British pound. In 1992, Britain was part of the European exchange rate mechanism, a system designed to keep European currencies trading within a narrow band against each other. The anchor of this system was the powerful German Deutsche Mark. But after German reunification, the Bundesbank, Germany's famously inflation-averse central bank, was forced to raise interest rates. This created a huge problem for Britain, which was stuck in a deep recession and desperately needed to cut interest rates. But it couldn't. To keep the pound pegged to the mark, Britain had to keep its own interest rates high, strangling its economy. Stanley Druckenmiller, who by now was running the quantum fund for Soros, saw the setup. It was another one of those beautiful asymmetrical bets. There was a significant chance Britain would be forced to devalue the pound. There was almost no chance the pound would go up. The downside was limited, but the upside was enormous. Druckenmiller began to build a position against the pound. Then Soros went to a meeting in Europe and heard Helmut Schlesinger, the head of the Bundesbank, basically say that he didn't care if Britain and Italy had to devalue. The Bundesbank's only priority was fighting German inflation. Soros immediately called Druckenmiller. This was the trigger. Druckenmiller walked into Soros's office and said it was time to build on their position steadily. Soros looked at him, puzzled. "That doesn't make sense," he said. "If they knew they were right, why be timid? Go for the jugular." Over the next few days, they built a short position against the pound worth $10 billion. They were selling sterling to anyone who would buy, and the main buyer was the Bank of England, which was legally obligated to defend the peg. It was a massive transfer of wealth from British taxpayers to a global army of speculators. On September 16, 1992, a day that would become known in Britain as Black Wednesday, the Bank of England tried to fight back. It raised interest rates from 10% to 12%. The market didn't even flinch. It announced another hike to 15%. Nothing. The avalanche was too powerful. That evening, a defeated British government announced it was pulling the pound out of the exchange rate mechanism. The markets had won. Quantum's profit on the trade was over $1 billion. Druckenmiller, however, always called it White Wednesday. He believed they had liberated Britain from a flawed policy, freeing it to cut interest rates and save its economy. Whether hero or villain, Soros was now known as the man who broke the Bank of England. Hedge funds were no longer just a financial curiosity. They were a geopolitical force. While the macro traders were making headlines, another giant was quietly building an empire based on a completely different philosophy. This was Julian Robertson, a booming, charming Southerner who created Tiger Management. Robertson was not a macro trader or a quant. He was a stock picker, a disciple of the A.W. Jones model. His philosophy was simple: find the 200 best-run companies in the world and go long, and find the 200 worst-run companies and go short. He dismissed macro commentary as gibberish. His edge was his incredible ability to judge people and businesses, and his almost cult-like force of personality. Working for Tiger was like joining a special forces unit. Robertson hired jocks, alpha males, in his own image, and he pushed them relentlessly. He would flatter them 1 minute, "That is the best idea I ever saw," and crush them the next, "That is the dumbest idea I ever heard." He created a culture of intense competition and loyalty. He knew everyone, and he used his vast network to get information nobody else had. Between 1980 and 1998, Tiger earned an average of nearly 32% per year, trouncing the market. Robertson proved that even in an increasingly professionalized world, there was still room for a master stock picker. But Robertson's incredible success created a challenge that would ultimately lead to his downfall. He became a victim of his own legend. The more money he managed, the harder it was to find enough great ideas. And his value investing philosophy, which had served him so well for 2 decades, was about to collide with a force that defied all traditional logic: the dot-com bubble. In the late 1990s, the market went insane. Internet companies with no earnings, no profits, and sometimes no viable business plan were soaring to absurd valuations. Robertson saw it for the mania it was. He likened the Nasdaq to a locomotive hurtling down the tracks, certain to crash. But he was a value investor. He couldn't bring himself to buy into a bubble he knew was irrational, and shorting it was like standing in front of that locomotive. So he chose to ignore it. He stuck to his old economy value stocks. But as the bubble inflated, his performance suffered terribly. His investors, watching teenagers get rich day trading tech stocks, grew impatient and started pulling their money out. This forced Robertson to sell his best holdings, which created a death spiral. Rivals knew what he had to sell and bet against him. In March 2000, just as the bubble was finally beginning to burst, a beaten and exhausted Robertson announced he was closing Tiger. In his final letter to investors, he lamented a market where mouse clicks and momentum had replaced rational valuation. The market, as Keynes had warned, had stayed irrational longer than he could stay solvent. At the same time, Stan Druckenmiller at Quantum was fighting his own battle with the bubble. He too saw the insanity. Early in 1999, he tried to short the tech stocks and got obliterated, losing $600 million in a few weeks. It was a humbling experience. But unlike Robertson, Druckenmiller was a flexible, pragmatic trader. He wasn't wedded to any single philosophy. Painfully, he reversed course. He bought the very same radioactive stocks he had just been shorting. He rode the bubble for all it was worth. Quantum went from being down 18% in May to up 35% by the end of the year. It was one of the greatest comebacks in hedge fund history. But in early 2000, Druckenmiller too knew the end was near. He sold everything. But then, as the market continued to surge for a few more weeks, he lost his nerve and jumped back in, just in time for the crash. Quantum lost 21% in a matter of weeks. Like Robertson, Druckenmiller was exhausted. A month after Tiger closed, Soros announced that Druckenmiller was leaving, and the Quantum Fund would be restructured into a more sedate, lower-risk vehicle. It seemed like the end of an era. The 2 biggest, most storied hedge funds in the world had been humbled. Soros himself declared that a large hedge fund like Quantum is no longer the best way to manage money. But he could not have been more wrong. A new era was just beginning, one that would be driven not by a handful of legendary geniuses, but by institutions. The man who opened the floodgates was David Swensen, the chief investment officer of the Yale University Endowment. Swensen was a brilliant economist who realized that hedge funds, with their promise of high returns that weren't correlated with the stock market, were the perfect investment for an endowment. They offered the one, free lunch, in economics, diversification. In 1990, Yale made its first hedge fund investment in a small event-driven fund out on the West Coast called Farallon, run by a young man named Tom Steyer. Steyer specialized in event-driven investing. He didn't try to predict the whole market. He focused on specific events like mergers or bankruptcies that scrambled a company's value. His returns were steady, understandable, and completely independent of the S&P 500. This was the alpha that endowments were looking for. Following Yale's lead, universities, pension funds, and foundations began pouring billions of dollars into the industry. Hedge funds were no longer just the playground of the super-rich. They were becoming a core part of the institutional investment world. This flood of new money fueled the rise of the Alpha Factory's giant multi-strategy funds like Ken Griffin's Citadel. Griffin wasn't a trader in the old mold. He was a process-driven manager who wanted to turn investing into widget making. These new behemoths hired teams of specialists in every conceivable strategy, blending them together under one roof. But this rush to bigness created new risks. In 2006, a multi-strategy fund called Amaranth blew up in spectacular fashion. It had bet its entire firm on a single, brilliant young trader named Brian Hunter, who was making massive bets on natural gas prices. For a while, he was a hero, making billions after Hurricane Katrina. But his positions grew so large that he himself became the market. When the trade turned against him, he couldn't get out. The fund lost over $6 billion in a matter of weeks and collapsed. Amaranth's failure showed the dangers of the Alpha Factory model, but it also showed the resilience of the system. Citadel, Griffin's firm, swooped in and bought Amaranth's entire portfolio overnight, preventing a wider panic. One hedge fund had imploded, but another had acted as the firefighter. The crisis was contained. Taxpayers paid nothing. But a far greater test was coming. As early as 2006, a handful of contrarian hedge fund managers began to see the cracks forming in the U.S. housing market. They saw lenders like Daniel Sadek's Quick Loan giving mortgages to people with no income and no prayer of repaying. They saw Wall Street banks bundling these toxic loans into complex securities that were being stamped with AAA ratings and sold to unsuspecting investors all over the world. The man who saw this most clearly and who made the single greatest trade in financial history was John Paulson. Paulson was an unassuming, quiet manager who specialized in merger arbitrage. But in 2005, he became convinced that a massive credit bubble was about to pop, and he went looking for its weakest link. He found it in the subprime mortgage market. Wall Street had created a pyramid of mortgage debt, sliced into layers or tranches. The riskiest bottom layer was the BBB-rated tranche. It was only about 1% thick. This meant that if just 6% of the underlying mortgages defaulted, the entire BBB tranche would be wiped out. It would go to zero. Paulson realized this was the ultimate asymmetrical bet. He could buy insurance on these bonds, called credit default swaps. If the bonds survived, he would lose the relatively small premium he paid for the insurance. But if they went to zero, his payout would be 100 times his investment. He set up a dedicated fund to make this bet, and he went all in. He was betting against the entire American housing market, against Wall Street, and against the conventional wisdom of the entire financial world. In February 2007, the first cracks appeared. A major subprime lender announced massive losses. That morning, the mortgage index slid 5 points. Paulson's fund made $1.25 billion before lunch. By the end of 2007, his fund was up 700%. His firm had made $15 billion in profits. His personal take was between $3 and $4 billion. He had pulled off the new killing of a lifetime. The subprime crisis that Paulson had foreseen soon spiraled into the global financial crisis of 2008. In September of that year, the investment bank Lehman Brothers collapsed, triggering a panic that froze the entire global financial system. In the chaos that followed, Hedge funds were tested like never before. They suffered huge losses. They were hit by a government ban on short selling. Investors rushed for the exits, forcing many funds to gate their money, trapping their clients' capital. Nearly 1,500 funds went out of business. Ken Griffin's Citadel, which had grown to be a $15 billion behemoth, lost 55% of its value and came perilously close to collapse. It survived only because of Griffin's paranoid focus on securing long-term funding, a discipline that the investment banks had tragically lacked. But even in their worst year in history, hedge funds proved their worth. As an industry, they lost 19% in 2008. The S&P 500 lost twice that. And most importantly, unlike the giant banks, investment banks, and insurance companies that had to be bailed out by taxpayers, the hedge funds that failed did so on their own. They were, for the most part, small enough to fail. So what do we take away from this incredible saga of risk, rebellion, and riches? Sebastian Mallaby's More Money Than God is more than a collection of thrilling stories. It offers a profound and deeply important lesson about the nature of our financial system. For decades, we've been told a story that hedge funds are the villains of modern finance, secretive, unregulated, reckless speculators who destabilize markets for their own gain. And this book doesn't shy away from their flaws. We've seen the hubris, the greed, and the moments when these titans push the limits of the law and of reason. But the real story, the one Mallaby tells so brilliantly, is that the true danger to our economy has never been the small, nimble, and paranoid hedge funds. It has been the giant, supposedly safe, and government-backstopped institutions, the too-big-to-fail banks. The central idea here is one of the most important you'll ever encounter in finance: the difference between institutions that are small enough to fail and those that are too big to fail. Hedge funds are, by and large, small enough to fail. When they make a bad bet like Amaranth did with natural gas, they blow up. Their investors lose money, the manager loses his reputation, and the fund disappears. It's painful for those involved, but the system as a whole survives. Capitalism works. Failure is punished. But when a giant bank like Lehman Brothers or AIG makes a bad bet, the government can't let it fail. The fallout would be too catastrophic. So taxpayers are forced to step in and bail them out. This creates a terrible moral hazard. The banks know that if they win, they keep the profits. If they lose, the public covers the losses. It's a system that privatizes gains and socializes losses, and it actively encourages reckless behavior. Hedge funds, for the most part, operate outside this broken system. They don't have government deposit insurance. They don't have access to the Federal Reserve's emergency lending. They live and die by their own risk management. And as we saw with Ken Griffin's Citadel, that forces a kind of paranoid discipline that is often lacking in the boardrooms of the big banks. This leads to a deeply counterintuitive conclusion. The path to a safer financial system isn't to regulate hedge funds into oblivion. It's to encourage a system where more risk is taken by smaller, independent firms that can fail without threatening the entire economy. We need more institutions that are small enough to fail, not fewer. So how can you apply the lessons of these financial masters to your own life? First, learn to think in terms of asymmetrical bets. This is the secret of Paulson, Soros, and all the greats. They look for opportunities where the potential upside is many times greater than the potential downside. This isn't about gambling. It's about finding situations where you can risk a little for the chance to gain a lot. In your own life, this could mean learning a new skill, starting a small side project, or taking a calculated risk on a new career path. Ask yourself, what's the most I can lose, and what's the most I can gain? When that ratio is heavily in your favor, you've found a hedge fund-like opportunity. Second, be a contrarian. Every story in this book is about someone who saw the world differently from the crowd. They questioned the consensus, they bet against the prevailing wisdom, and they had the courage to hold on to their convictions. The greatest opportunities in life, whether in finance or elsewhere, are rarely found on the beaten path. Learn to listen to that quiet voice inside you that says, "What if everyone else is wrong?" That was a summary of More Money Than God by Sebastian Mallaby. We've journeyed through the minds of some of the most brilliant and audacious investors in history, but I'll be honest with you, a summary can only take you so far. The real magic happens when you read the book yourself. It's in the quiet moments, when a particular story, or a simple phrase from Mallaby's masterful prose, hits you in a way you didn't expect. This summary is designed to help you decide if this book is worth your time. If anything we've talked about today has resonated with you, the stories of rebellion, the intellectual puzzles, the high-stakes drama, then I truly encourage you to grab a copy. Reading it isn't just learning about finance. It's an experience that can genuinely change the way you see the world of money, risk, and power. You can find a link to the book in the description below. Also, if you found this summary valuable, please do me a small favor and hit that like button and subscribe to the channel so you don't miss our next journey into another life-changing book from the billionaire's bookshelf. Your support means the world and allows us to keep exploring these incredible ideas together. Let's keep growing.